If you own a single share of Apple, congratulations. You're a part owner of a $2 trillion company. They technically owe you money. Most people think the stock market is this chaotic casino where rich people gamble and regular people get burned. And sure, it can look that way if you only watch it on cable news with the red numbers and the panicking anchors. But the stock market is actually one of the simplest, most boring concepts in finance. It's a store. That's it. A store where you buy tiny pieces of businesses. Today we're explaining what it actually is, why prices move, and why the whole thing trends up over time. Even through wars, recessions, and that one time, the entire world shut down for a year. Welcome back to Capital and Capybaras. Let's start with the most basic question that nobody actually answers clearly. What is a stock? A stock is a piece of ownership in a real company, not a symbol on a screen, not a line on a chart, not a casino chip. When you buy one share of Apple, you legally own a fraction of their offices in Cupertino, their pile of cash, their patents, their inventory of overpriced dongles, all of it. You are a co-owner of that business. Now you own a very small fraction. If you have one share of Apple, you own about 1/15 of the company. Your voting power at shareholder meetings is, let's say, decorative. But the principle matters. Stocks are not abstract numbers. They represent real ownership of real businesses that make real things and earn real money. This distinction is everything. When the stock price drops, you didn't lose a bet. The market just temporarily changed its opinion about what your ownership is worth. The business is still there, still making iPhones, still selling them for $1,200. So, if a stock is ownership in a company, the stock market is just the place where people buy and sell those ownership pieces. That's it. It's a marketplace. Think of it like eBay, but instead of vintage furniture and questionable electronics, people are trading slices of businesses. Someone wants to sell their piece of Microsoft. Someone else wants to buy it. They agree on a price. Done. Transaction complete. The New York Stock Exchange, the one with the building and the bell, is one marketplace. Nasdaq is another one, except it's entirely electronic, no building required. There are stock markets all over the world. Tokyo, London, Shanghai. They all do the same thing, connect buyers and sellers of company ownership. And this isn't new. The Dutch East India Company started selling shares to the public in 1602. People have been trading business ownership for over 400 years. It's one of the oldest financial concepts that still works exactly the same way. When you hear the market is open or the market is closed, that's just store hours. The US stock market is open weekdays, 9:30 a.m. to 4 p.m. Eastern. That's it. It's a store with business hours. It closes on weekends and holidays, just like the post office, except people somehow find it more dramatic. Here's where people get confused. If a stock is just ownership in a company, why does the price change every second? The company doesn't get 10% better between Tuesday and Wednesday. So what's going on? Prices move because of supply and demand, but not in a random way. They're driven by expectations about a company's future profits. If Apple announces record iPhone sales, people expect higher future profits. More people want to own a piece. The price goes up. If a company announces layoffs and falling revenue, people expect lower profits. They want out. The price drops. In the short term, prices are driven by emotions, guesses, and whatever nonsense is trending on social media. The legendary investor Benjamin Graham put it perfectly. In the short run, the market is a voting machine. In the long run, it's a weighing machine. Short term, it's a popularity contest. Long term, it measures actual business performance. This is why day traders mostly lose money and patient investors mostly make money. The voting machine is noisy and unpredictable. The weighing machine is boringly reliable. So when you see the market drop 5% in a day, that's not the economy collapsing. That's millions of people simultaneously changing their guesses about the future. Sometimes they're right. Usually they're overreacting. The underlying businesses are still open the next morning, still selling products, still making money. This is the most important section of this episode. If you understand this, you understand why investing works. The stock market has returned an average of about 10% per year for over 100 years, through 2 world wars, through the Great Depression, through the dot-com crash, the 2008 financial crisis, and a global pandemic. It always recovers, and it always goes higher. Why? 3 reasons. First, businesses create real value. Apple designs a phone, manufactures it for $400, sells it for $1,200. That $800 of value didn't exist before. It was created. Multiply that across millions of companies making millions of products and services, and you get an economy that produces more value every year than the year before. Stocks go up because the businesses behind them are genuinely creating new wealth, not moving money around, creating it. Second, the economy grows. More people are born, they get educated, they innovate, they build things. Global GDP has gone up almost every single decade for centuries. Not because of luck, but because humans keep solving problems and making better stuff. When the economy grows, corporate profits grow and stock prices follow. Third, companies reinvest their profits to grow even more. Amazon didn't just sell books and sit on the cash. They reinvested into cloud computing, streaming, logistics, and somehow selling you batteries at 3 a.m. That reinvestment creates even more future profit, which pushes the stock higher. It's a compounding cycle, the same concept from episode 1, but happening inside every company in your portfolio. Put it all together. Businesses create new value, the economy expands, and companies reinvest to grow. That's not hope. That's not optimism. It's the structural reality of how capitalism works. The stock market goes up because the pile of real stuff in the world keeps getting bigger. Let's kill this comparison once and for all. People love saying the stock market is just gambling. It's not. And the difference isn't philosophical, it's mathematical. In a casino, every game is zero-sum or worse. When you win at poker, someone else loses. When you play slots, the house takes a cut of every spin. Over time, the casino always wins, and the players always lose. That's how it's designed. The stock market is positive sum. When you buy shares of a company, that company uses capital to create products, hire people, and generate profits that didn't exist before. New wealth enters the system. You're not betting against other investors. You're all co-owning businesses that are creating value. When Apple sells $1 billion worth of iPhones, that's $1 billion of new economic activity. The pie gets bigger. Everyone who owns a slice benefits. Here's the wild part. In the stock market, the house edge is actually in your favor. Over any 20-year period in US history, stocks have had a positive return. Every single one. Not most of them, all of them. You just have to stay seated. The only way to reliably lose in the stock market is to panic sell during a dip or to bet everything on one company that fails. If you buy the whole market and hold it, which is exactly what an index fund does, history says you win. Every time. So here's the stock market demystified. A stock is real ownership in a real company, not a lottery ticket, not a casino chip. The stock market is just a store where people buy and sell those ownership pieces. Open weekdays, closed weekends, less exciting than TV makes it look. Prices move because people constantly update their guesses about future profits. Chaotic short-term, reliable long-term. And it goes up over time because businesses create new value, the economy grows, and companies reinvest to get even bigger. It's not gambling because new wealth is being created, not redistributed. The pie gets bigger. You own a slice. Relax. If this finally made the stock market click for you, hit subscribe. Next episode, we're covering index funds in depth, what they are, why they work, and why the most boring investment strategy on the planet has quietly outperformed 90% of professional money managers for decades. Drop a comment with your biggest stock market question. We might answer it in a future episode. And if you haven't invested your first 1,000 yet, go watch episode 7. It's a 15-minute setup guide. Stay chill